So let's start with equity. Avoiding private equity because we've already heard about that, although we may stray into the PE space in connection with debt during the course of this panel. For those of us who've been to the last 3 or 4 major mining conferences, the equity story seems to have been quite tough, but I wonder if our panel believe that feeling is warming towards the mining and metal sector in any way in the public equity space. And I think we'll start with the 2 guys who actually run mining companies, David and Tom.
Well, we've managed to raise about 130 million in equity over the last couple of years, the bulk of which was done at the end of 2012. And we've also managed to do straightforward debt finance for a project. I think if you've got a good project, if you've got grade, and your shareholders can see a return within a time span, then the opportunity is still there for equity. One of the pluses, of course, of doing equity with everyone is guaranteeing returns for all your shareholders, rather than going some of the other way where you end up with particular shareholders having greater returns, or royalty companies or streaming companies taking greater returns. So, if you can get it done for a good project, that's still a good way to go. And I think that, negative gold equity cycles are normally 2.5, 3 years. This one's gone on for 4 years. I think, at some point we will see investors come back to the resources sector as a result of the ending of a cycle.
I would agree with David. If the project's good enough, you can raise money. Having said that, it is challenging. We raised some money in the equity markets recently. It was more expensive than we expected. We had to issue half a warrant with each share, but we still managed to raise the money we needed.
Perhaps just to add in, and then again, this is not to depress the room here, but since we are in London, obviously there's a merit of checking in and seeing what's been done on LSE, right? Now, just I'll throw you the statistic by saying that capital raisings in terms of the IPOs, the pure IPOs on LSE in the last 10 years, guess how many there have been? A wild guess from the audience. Ian?
I'm a debt guy.
Well, there's been 5 IPOs on LSE, which is obviously quite an important market, because when we think metals and mining, besides, of course, Australia and Canada, we do think London. London as a marketplace for metals mining. Well, 5 IPOs. Now, interestingly, so you're talking last 10 years, 5 IPOs, and then you're saying, well, how much was raised? I would say 9 billion sterling, okay? Now, if you look, out of the 5 companies, you had 3 Kazakh names. Well, I think that's over. Then you had African Barrick Gold, and then you had Glencore, and Glencore was 6 billion out of the 9. So here's the landscape. Now, interestingly enough, I do remember when we were preparing the IPO of Glencore, everyone was saying, well, you'll see, Glencore does the IPO and then the market drops dead. Well, that's precisely what happened. I mean, the Glencore was the last IPO that we did, and since then it's been quiet. Now, there have been, to be fair, there have been raisings, there have been accelerated book buildings, and there have been rescue rights issues on LSE, but again, the volumes and the activity is not there. Now, are we looking to say that today, in this current environment, the IPO market in London is about to reopen for mining companies? No way, we don't see that. Now, why we don't see that? Because if you look at the track record, and my colleagues just mentioned, the super cycle. We were all going super cycle, yes, China, great. It was a little bit of a pyramid scheme. Now, if you descend and you look what happened in the last 10 years or in the last 15 years, technically, we're still not yet at the level of the trough where everyone kind of like, we went to the trough, we're really at the bottom, and then we're trying to think positively and seeing the future. Because the last trough, if you look, unfortunately we don't have the graphs here, but if you mentally kind of see in front of your eyes, basically what's happening with the mining companies, they are very much dependent on the prices of the commodities, of the underlying commodities. I mean, of course, then you have the different differentiators between the management performance, the type of the commodity, but if you agglomerate and you do the averages, you would see that the market capitalizations of the majors or of the juniors have been pretty much following whatever the commodity prices have been doing. So if we go back, when was the last trough? It was in 2008, 2009, where we dropped. Now, if we look at today, where we are today, we're still not there yet. Well, maybe, hopefully, we would not be there yet, and we all pray. But again, because it's a cyclical industry, you know, we still have some way to go, probably. And therefore, like we are, I'll be very frank, we have been having IPO candidates and the pipelines over the last years. In the last 2 years, it's been dry. It's been dry, and I think this is the reality. Again, I'm speaking more of EMEA space and the European stock exchanges. I know that Canada is different and Australia is different, where it's very much populated by junior miners. But if we're looking at kind of companies that are you know, the future stars of this industry, not ready yet.
Right. And ready in?
Well, one needs to be optimistic. You know, I've been in this industry for the last 11 years, so I hope to run for the next 11, and, you know, you never know. You just need to, well, I think we all collectively need to create the circumstances for the industry to be there. But if you look at the fundamentals, mining is there. I mean, it's just so fundamental to our life in terms of the usage that I hope that maybe in the next 2-3 years we see a different picture.
Right. George, any perspective from the advisory space?
Yeah, well, I'm always optimistic as well, because my first day at work at Rothschild 15 years ago, the gold price was $252 an ounce, and banks were running downsides at $220 an ounce. So we're always optimistic. I think the equity side is tough. We don't really see an improvement in the near term being 12 months. I think that the cycle has got a way to go. I think the cycle, the reasons for the trough this time around are different to 2008, 2009. I think that was a financial markets-driven crisis, whereas this time around, I think it's a bit more prolonged. There's a lot of uncertainty about China. When are they going to re-hit their 7% growth target? So, but there are signs that the Chinese government is priming the pump and easing up on bank lending within the country. So we're optimistic that the cycle will change. I think, you know, that's the nature of this business, but sadly not in the short term, and that means that, you know, the alternatives to the public equity market are key at the moment, right, certainly for our clients. And
Ignacio, perhaps some perspective on the public markets, but more interestingly, how multilaterals, DFIs, ECAs such as yourself sort of step up maybe to move into the vacuum of equity markets.
Yeah, well, for sure. I mean, public markets and the dumps, and I think there's always a question. Mining is probably the longest term of industries, and yet financing with short-term money doesn't seem to make eminent sense. But so that short-term money has, in a way, sort of evaporated. But there's plenty of long-term money available. So we've talked about PE funds, sovereign wealth funds, and to a certain extent even strategics. So there's plenty of that available, and that's the type of money that we're sort of bringing. And what we're looking for, particularly in this part of the cycle, are essentially three things. One is obviously the quality of the asset, so low cost, first quartile, or close to that type of asset. Second is alignment of incentives with either the ideally with the management team and other shareholders, and that's key in this part of the cycle. You know, when we've disregarded that type of alignment issue, we've paid for it dearly. And I suppose the third thing is, in this particular part of the cycle, is fully funded or close to fully funded propositions. So, you know, before you used to fund a junior to get to the next fundraising in 6 to 9 months' time, that doesn't work anymore. You have to have clear line of sight to either cash flow or a clear value point. So those three elements are three elements that we look at very closely. And it's, in a way, what lots of people are looking at, and particularly longer-term investors. So for us, it's a question right now of really partnership. It's partnership with private equity firms, it's partnership with majors, it's partnership with sort of similar long-term investors. And we have been doing that. I mean, on the oil and gas space that I cover, we're partnered with Warburg Pincus on an oil and gas platform for Africa. In the mining space with Appian, we're looking at doing things with potentially co-investing in the same company as Tembo. We're in the similar same company as Ahmed. So it's really co-investing with the private equity firms and also with the majors. As I mentioned, we've always partnered with BHP in Escondida, Newmont in Yanacocha, etc., and with Rio in Simandou. And so those types of partnerships are things that we want to continue. In Escondida, we were there for 22 years. In Yanacocha, we've been there, and we still are. We've been there for 23 years. It is a long-term industry, and you have to associate with people who are going to take that long-term perspective. Other than that, otherwise it's pure, I wouldn't say speculation, but you have to look at it long-term.
Right. So public equity market's struggling, but there are clearly equity solutions in a variety of different ways. So moving to debt, we'll come back to some aspects of equity. There are a variety of debt financing options for mining companies, and we'll look at some of them in further detail further on in this panel session. But just sort of generally, what's the sort of liquidity situation for each of these debt products out there? There are plenty of people vying to provide them for the right project. George?
Yes, definitely. I think the challenge for us and our clients and other mining companies is not the debt side of the equation, it's the equity that goes with it, because we're not in the sort of cycle where banks or debt-like products are going to fund 100% of a project's capital needs. I think that generally the banks are quite hungry, looking for projects. I think a lot have obviously sorted out their balance sheets from sort of 2008, 2009 era, and there are some good mining teams out there with good in-house technical knowledge who can look at greenfields projects and have got appetite for political risk, not everywhere, but in quite a lot of places. So I think the banks are there, definitely. To the extent the banks aren't there, the development banks, export credit agencies are. I mean, they have their own challenges in terms of levels of due diligence, somewhat, should we say, longer timeframes to get deals done, with the utmost tact to my fellow panelist. But we've done several deals and actually are doing two with the IFC at the moment. So we know them well. We know the other development banks well. We know generally what they need, and they do have a higher threshold, particularly on the social and the environmental side, compared to the commercial banks. And then there are the slightly less traditional sources of finance, such as streaming companies. Some other private equity firms will look at debt-like products, and we obviously heard the previous panel and some of their views on some of these debt-like products are looking for equity returns, but generally are available. And then there are specialist funds like Red Kite or Orion who sort of sit in the middle and are looking at metals content. So I think on the funding side, actually, I'd be pretty positive in terms of getting a project from feasibility study into construction. The challenge is, if it's not a good project with good grade and a good management team, they'll struggle with the equity side.
Anna?
I think maybe to add just a few words, we at BNP Paribas in our team, we have a portfolio which is several $1 billion, and it's basically both mining and metals. And it's a very good portfolio, very diversified. To give you a perspective in terms of the activity in the syndicated loans market, for example, for metals and mining space in EMEA, last year, I think we had the volumes of about $75 billion. Interestingly enough, in the last 5 years, most of the volume, well, about 45% was actually the refinancing. So it means the liquidity is there, and then obviously, there is a constant access to the funding and financing. In terms of the mining space, I think you're looking at project finance mining. Well, the volumes have come down a little bit. I say 5 years ago it was 75% of the activity. Now it's gone maybe to 60. But again, I think banks are, in general, the population is much more selective in terms of what we're backing. Well, we as a team, actually, what we're trying to do, we're trying to accompany, I think the environment has changed. There's been a dramatic shift, I would say at least 3-4 years ago, when the industry changed and the banking industry also tried to look at the opportunities differently. So instead of kind of compartmentalizing everything into sub-products, we're looking, okay, well, here's the client and what is the solution that we can offer. So in terms of the financing aspect, we're looking at everything. You know, we would be doing prepayments, where we can actually off-take the physical metal, whether if it's LME grade, we will gladly off-take that. We do the classical project financings, you know, whether it's a smaller scale or a bigger scale. Just to give you an idea, just yesterday, one of our clients, we announced a new deal that we already committed. It's Alistair Gold. It's project financing for the expansion of their gold mine in Turkey, which is one of our home markets. It's a finance of 250 million for the project finance, which is 630. So we do this type of deals. Then we look at someone, and I've noticed that George was not here from Rio Tinto, probably because he didn't want to field the Oitolgoi questions, but we're here with Ignacio, so we'll give you a preview. We're still very much committed to this project. Because we're both, our both institutions are actually very much, well, keen to proceed with this $4 billion underground mine phase expansion. And we are on standby. And on that particular end, just to give you an idea, well, IFC is obviously doing their job, and we as a commercial bank are one of the MLAs, and we're also looking at all the ECA components and you know, coordination of ECAs, and we also do ourselves the export financing just to provide even a longer yet complementary leg to the PF. So again, from our perspective, I think the liquidity is there. The interest is there, and it's all about selectivity, because again, we've seen, because of the super cycle, we've seen so many propositions that didn't make sense. So many projects, to give you an idea, in Africa that didn't have access to any type of infrastructure. I mean, mining is great, but mining is worthless if you can get the stuff out of the mine and transport it where it needs to be, right? So that's...
Okay. Thank you. David and Tom, you've both raised debt financing of one variety or another over the past couple of years successfully. So, bees around a honeypot with providers, or it's been a little more difficult than that?
I think it's a chicken and egg problem. You know, debt financiers want to see the equity component, as George said, and I think that we were lucky enough to do principal equity component at the sort of end of a cycle, if you like. And then we were also fortunate enough to, in the ORIS experience, to have the Export Credit Agency of South Africa underpin the 100 or 80 million of the 100 million, 88 million of the 100 million loan with Nedbank and RMB. And you know, traditional debt project finance obviously takes longer. But what I would say is, you know, you go through a stringent due diligence process, which effectively protects the investors. You know, investors and us know that we've been due diligence to death one way or the other, including the IFC, which is not a negative. I think that it's important, but you know, because we use the Export Credit Agency of South Africa, the primary debt came in at a very low rate, and the conditions were not stringent. And it also helps banks. Now that window, that particular window isn't open anymore.
It's not?
No.
Well, last year when we acquired the Yanfalila project from Goldfields, we went out to try and secure a debt solution for it. We had basically, I guess in some ways, bees or something around a honeypot, and we had many people wanting to provide us different sorts of structured debt as a bridge, and then potential follow-on finance. We ended up taking a 10 million bridge from Taurus Mining Finance and their debt fund with a mandate for the full 75 million facility. We chose to go with those guys because, to be honest, their product was probably the cheapest. It was the most flexible, and they're a small team who wanted to work with us, who liked gold and didn't have a concern about the political risk of Mali.
Just to add to what David was saying on the sequencing of debt and equity, I think this is a pretty helpful point at the moment, that basically if the debt financing can be put in place or near put in place, it's a huge tick in the box from a diligence perspective on the equity. And a couple of examples, we worked with Nevsun in Eritrea. This was five or 6 years ago, and Ian was obviously involved as well as legal counsel. And we put a big for Eritrea, $230 million debt facility together, fully credit approved and basically working through conditions precedent. But this was Eritrea, and this was 2009, so this was around the time that the United Nations put sanctions on Eritrea because of their perceived support, should we say, for terrorist activities in Somalia, destabilizing their long-term enemies in Ethiopia. But to cut a long story short, the banks couldn't get to the final drawdown because of these UN sanctions and the uncertainty of interpreting these sanctions. But it meant that the company could go to its 4 largest shareholders and say, look, this project has been fully diligenced by Export Credit Agency, actually ECIC from South Africa, development banks from Europe, and commercial banks, of which BNP was actually one. And that meant that the company could actually raise the equity. Now, it wasn't their ideal solution because actually in terms of dilution, it was a dilutive financing. But you look at Nevsun now, they've got $500 or $600 million of cash on their balance sheet, and they've never looked back. You know, the CEO says it was the best deal he never closed. And there's another example, Guyana Goldfields, which we did last year, which IFC was a lender to, needed to raise equity to complete the financing. Another example would be Ramarco Minerals in the US, had a huge equity need, but once the debt was basically credit approved and in place, they could do a big financing of over $200 million, and that was in the public market. So I think from our perspective, moving the debt side of the funding challenge to a place where it will convince the equity to come is a key part of what we're doing at the moment.
Yeah, just a point of that. I think the reality is, if you look at the junior space, single asset space, there are a number of zombie projects. Zombie in the sense that market cap is extremely low, and there's a huge gap to be filled if they were to sort of be able to project finance. And I mean, that represents obviously a great, it's not very realistic for a company with a $10 million market cap to raise $100, $150 million in equity. Unless, and here's where sort of the M&A sort of comes in, unless it's picked up by another company which has already got a producing asset or producing assets and see this as a second or third or fourth asset that can be optimized and put as a option down the road. So that hasn't really happened, but it is something which is an opportunity for those mid-tier producers to pick up some pretty cheap assets which are currently in sort of zombie mode.
Actually, I think David from Ahmed on the previous panel said that one of his banker friends had said they were drifting away from single projects in Africa as single project companies, I should say. You see that, or?
I think it's, well, the risk is higher.
Right.
And I think for both, shareholders and financiers, it's just you have a concentration, and therefore the risk, the risk is very high. I mean, just to give you an idea, I mean, not even talking about Africa. I mean, let's consider the case in Finland of Talvivaara, the nickel. All the fundamentals were right, and then obviously the nickel price went completely the other way. And when you have all your business plan proposition, which is, for example, with nickel price at 17,000 and it's at 14, everything goes haywire.
Right.
And it is the only single asset company, and it was a big company, and then look at the story. So now we all hope that Audley Capital is going to turn it around and find a solution.
I think actually Africa is a bright spot for banks, and there are some particularly South African banks who've slightly pulled in their horns and are not really supporting financing outside Africa. But I think ECIC in South Africa is a huge benefit, potentially a huge benefit to mining companies, because if there's enough South African content, it will support very attractive financing. It takes a bit of time, as David will testify to, but it's cheap money, relatively cheap money, and the banks love it because actually the capital they have to allocate to the project is far lower because of the credit enhancement that you get from South Africa. So I mean, we've got a client in East Africa where, and it's broadly comparable to another one we're doing in North America. We've got a larger number of banks interested in the project in Africa than we do in the one in North America.
Is that because of the potential return pricing, or it's
well,
couldn't possibly say?
No, I think it's actually because I mean, I think the swing factor is the South African banks.
Right.
You know, banks, European banks will look at either project generally. I mean, there are a couple of the European banks that are really focusing on Europe and Eastern Europe now, unless there's specific European export credit content, for example. The North American banks won't support projects in Africa generally, with very few limited exceptions. Right. So I think the swing factor is the South African banks and the potential for the ECIC cover.
And is your sort of viewpoint that people will roll with governments messing around with royalty changes and carried interests, and as have been DRC and most recently Zambia?
I think DRC is very difficult for banks generally. I think other countries, I think generally it's honestly it's case by case, I would say.
Right.
There's no sort of blanket rule.
Yeah, I would agree, actually. I think there are some places in Africa where we definitely would not go. As far as DRC, for example, is concerned, we were happy to do M&A. We did the deal for Minmetals buying Anvil. It was a couple years back, but we are not comfortable lending. Mm-hmm. Again, I think what's important, and that is kind of taking it further in terms of, and it affects liquidity, and it depends also on each financial institutions. Because we're such a large institution, for us, for example, the CSR issues are extremely important. And I actually devised our CSR mining policy back in 2013, which is based on IFC principles and the World Bank principles. And basically, we have very stringent requirements in terms of which projects we would back up and consider for financing, and quite a few do not make the cut. So my question is going forward, would the other financial providers also look at CSR issues more closely and in a way make it a natural selection in terms of who moves forward and who doesn't? I mean, if I take it even further, for example, we always need to innovate. I mean, are we looking at some point in a couple of years, we already have the green bonds, and of course the green bonds, I mean, that would be very complicated for the mining, for the juniors, but my question is, I mean, are we looking, I don't know, next year, the beginning of the green loans, for example? And I think that would also, that would probably allow some of the companies to get easier access to financing, whereas for the others, maybe there will be further stringent requirements.
Right. I mean, David and Tom, you both develop projects or are developing projects in countries which are difficult in some respects. So any sort of observation on that, on how sort of finance providers have come at that, CSR issues and what have you?
Yeah, I mean, I think, Liberia's had quite a bit of money put in by the World Bank and the IFC, have a decent mining code based on the Tanzanian one. We were able to negotiate a good mineral development agreement, and with first mover advantage, we had fiscal stability put in. So I think that, obviously you can argue, well, we never really strategised for the Ebola crisis, but fortunately we've been able to come through that effectively and come out the other side, and we're going to pour first gold. So I think there's always risks in Africa, but the key is, is there a good government? Is there an enabling mining code? Is there a reasonable fiscal package? And for gold projects, relative infrastructure is a big thing rather than absolute infrastructure. So it depends on the project, depends on the location. We're very close to the port, and it's mostly tar road. That helps,
For sure.
It's all those factors, really.
Right. Tom?
Well, I'd add to that and say that any country in the world will have its own unique challenges. It doesn't need to be in Africa, it could be in Europe. However, if the country has a history of mining, which, for example, Mali has a very long history of gold mining, Liberia used to be the world's third biggest iron ore exporter. If they understand mining and the benefits it can bring the country, then you're in a lot better position than a country which is new to mining. But I think an investor who doesn't want to invest in a country because they don't like the sound of it and they've seen something on the news, they're probably not really looked underneath into the detail properly. You know, a knowledgeable investor should be able to make an assessment of each country on its own merits.
Right. Ignacio, I'm sure CSR and the like are very important to IFC and other official lenders. There was, I think somebody made a comment earlier about sort of time taken in due diligence, obviously not by you guys, but by some of the other DFIs. You got any sort of perspective on that?
Yeah, I think CSR, I think we would be advocating CSR for decades now, and really as part of a risk mitigation strategy of a company. When you look at the actual relative costs of CSR compared to insurance premium, etc., it's actually relatively modest, and yet we've seen how if you get it wrong, it can be extremely costly. So it really, when we look at companies, yes, obviously we look at CSR, but CSR is an indication of the overall approach of the management team to risk management and how they run their business. If they aren't able to appreciate the risk they're running by doing things wrong on that front, then they're probably missing the ball on lots of other aspects, whether it's cost control, etc. We've had numerous studies in terms of the correlation of good CSR practices and good financial returns. And it's actually pretty robust in terms of strong correlation. So again, we're always advocating CSR as something which is important to get right. We try and help the companies to get that right. You don't always get it right. I mean, it's at the end of the day, you're dealing with human nature, and human nature is complex and complicated, but at least trying to mitigate to the extent possible the risks, I think, is important, and that coming from senior management is very important. So yes, we do take time looking at that aspect. To be honest, in my personal experience, actually we don't take longer than commercial banks overall in the process. Nor do we take much longer than a private equity firm when we're looking at equity. I think it's actually relatively similar in terms of timeline in my personal experience. But we do look at those aspects in particular detail, which I think is warranted, and I think it's what both the company and actually other co-investors or lenders are looking for in terms of IFC's contribution to the overall due diligence process. So,
before the IFC became an investor, a lot of people said to us, the IFC CSR will drive you mad. Actually, when we went through the process of the IFC and worked with them, most of the things they wanted us to do, we were doing already, or we're planning to do. So, to be honest, most of it's common sense, as Ignacio said.
I think to add to that, if you look around the world at the moment, if you don't have a social license for your project, you effectively won't have a project for very long. And so one of the key aspects now is to have that sustainability, to have that support of the communities in which you work, which is very important.
We've sort of spoken about equity, we've spoken about principally senior debt solutions, project finance, streaming and the like. How about the sort of bit in the middle? Maybe high yield bonds, sub-debt, mezz, how's that doing for availability at the moment as a sort of solution to debt problems for mining companies? Anna, probably first.
Well, we haven't done much on the high yield front. I think it's if I try to place it on the spectrum in terms of the company's development, it's too difficult probably for the junior miners. Again, we see we've done some debt capital markets raisings. Well, for example, the latest one was we did for FKM, but FKM is you can call it a mini major already. It has developed so much. What we've done in the past, we've done some private placements of debt. But again, it was very targeted, and I wouldn't say it's very much spread. I think it's all, again, the type of investors you have, they're not that used to the space, in terms of our opinion, and they flip more often. So it's probably not the right investor at the stage, you know, where you're developing just the project, where the project finance or, you know, private equity would be more appropriate, or other forms of financing. Again, this has been our experience, but I'm happy to hear from the panel.
I would agree. I think there have been 4 examples of greenfields project bonds. 3 are in liquidation or bankruptcy, and 1 is teetering on the brink at the moment. And we advised on one of them. I think they happen to be in the iron ore space, which is probably one of the reasons why most of them are not doing very well. But I think the challenge with project bonds is, well, there are a number of challenges. One, there's a long construction period, so any bond is going to have to basically pay for itself in terms of, you know, they like to have drawdown day one, and then there's a construction period during which you're not generating any cash flow, so you have to borrow the money to pay the interest. The second challenge is a lot of the investors are fairly opportunistic. The window sort of opens and closes on a not quite random basis, but seemingly so. And I think given that a lot of the people who've invested in those bonds have been burned, I think it's really off the table for some time to come. In terms of sub-debt and more, you know, products in the middle, I think they tend to come as part of another solution. So, for example, for Tom and Hummingbird, that's an example of you know, a bridge going into a senior facility. We're talking to a number of other funds, a bit like Taurus, who are interested in being part of a financial solution. I think that they're pretty dangerous. They're high risk because you're in bed with one provider, and if you know the bridge doesn't convert into the financing, then it's not a bridge, it's a pier. But yeah, that would be my perspective at the moment.
Yeah, I'd add to that George said. I mean, you know, at the end of the day, subordinate debt isn't a solution. It's part of your overall package. Bonds are a real challenge in the sense that it can look attractive, but really you should only consider it in a boom time when you can pay back quickly. And interest starts from day one. And bondholders can be pretty unforgiving if you have a poor quarter. So, you know, I think, again, streaming and royalties, you know, I personally don't like the royalty formula because you increase the threshold of the project and you end up only giving return to a limited, well, you give the return to whoever gave you the royalty, or money for the royalty, and everybody else loses out. So if you can avoid giving returns to specific people and try and give returns to all your shareholders, that's better.
Right. I think just to come back on the sub-debt point, one thing to add is one place where it can have you know, can fit in is with the development banks, because their ethos is, you know, development financing for a country. They're not as motivated by commercial banks, for example, in terms of actual return on capital. And so there are a few examples where development banks have provided subordinated debt. It may not actually be structurally subordinated, but it may be subordinated in terms of repayment, a longer tenor tranche of debt, and that can have its piece in the puzzle. But I think you need to have an alignment of interest between the senior debt and the subordinated debt. Otherwise, you end up spending huge amounts of time arguing about intercreditor issues.
Yes. I think the key point there, we're very minded on return on capital, but so it won't necessarily be cheap. But I think the key question about whether it's bond issues, subordinated debt, is who you're getting in bed with, and how patient they will be, or how understanding they will be if there's a little bump on the road, and also the fact that I think they have bonds and subordinated debt sometimes have, or weird structures have a bad name because they have been used when the company has run out of other options. And so they've been part of an over-leveraging of the company that has led to the downfall of the company. So, you know, and a bond for a company, a producing company, multiple assets, which isn't highly geared, that's a good sort of avenue to tap another source of liquidity. It's just if it's used as a last resort, For example, IFC, we do invest actually in bond issues. So in the oil and gas space, we underwrote part of a bond issue for Seven Energy in Nigeria. We're looking to do something similar in the mining space, which we hopefully announce relatively shortly. So it's not bad, but it's, what's the overall funding strategy, and who are your investors in whether it's subordinated or the bond issue.
Right.